STEM stock is the topic of today's presentation, and in today's STEM stock review, we're going to see what progress this company has made since they had their public debut via SPAC. Now, a lot of retail investors are attracted to stocks like STEM because the thesis is very intuitive. So the growth of renewable energy demands energy storage because the wind doesn't blow all the time and the sun doesn't always shine. And of course, energy demand fluctuates. So energy storage as a thesis can really be broken down into two components. You have commercial, which is grid scale storage. Then you have residential, which would be home batteries such as Tesla's Powerwall. Now, there aren't many viable plays out there, at least from the perspective of risk-averse tech investors, which is what we are. What we would look for would be a provider of lower margin hardware that supplements said hardware with high margin software. And software as a percentage of revenues, you would then expect to increase over time. And that's what STEM set out to be. You can see here the title of their SPAC deck. It says, Leader in AI-Driven Storage Solutions. So they nailed the use of AI right off the bat. And they keep stressing that usage even back when they had their SPAC. And when you look on the right here, you see their gross margin targets. So hardware would be 10 to 30%, software upwards of, let's say, around 80%. Now, the last analysis we did of STEM stock concluded a number of things. They have a lot of metrics that they offer up which detract from transparency. So it really just comes down to revenues. And you're going to see in today's presentation why that's particularly important with what we've recently discovered about STEM. They don't use traditional SaaS metrics to portray the health of their business. Maybe that comes later. And this line item here, perhaps the most concerning, 79% of their business involves reselling solar hardware purchased from other manufacturers. And we're going to talk a little bit about why that's even more of a concern. And then we concluded here, if STEM wants to sell themselves as a SaaS firm, they need to start acting like one. Well, today's presentation really took a fresh look at STEM. We didn't even view that presentation that we did a year ago, and you forget very quickly what you analyze. So we really took a fresh look at what the firm is up to, and we noticed something, I believe, in last presentation that was brought up, which relates to gross margin. So you can see here for the last quarter, Q1 2023, that software and services are 22%. Hardware has a negative gross margin. That's very problematic because it means they're selling a hardware product for less than it costs to purchase. And since they're a reseller, that's very concerning. So then you can see the comparison of those gross margins to the quarter last year. Now, when you look at their financials, you see something interesting here. They refer to GAAP gross margin and non-GAAP. We covered this in our last presentation, talking about how we always pay attention to GAAP. And in today's example, you're going to see why that is. So the first question I'd have here is, why in 2023 did GAAP decline from 9% to 1%, yet gross margin climbed from 16, or say non-GAAP, climbed from 16% to 19%. Well, they break that down for you, which is great. And here you can see those numbers. Now, the first thing to note is that typically amortization isn't included in COGS. So you can see here towards the bottom where they're adding that back in. Amortization of capitalized software, that's software that they developed internally. And then they have impairments, which have a very small impact on this gross margin. What I wanted to focus on here is in this first column for 2023. You see in the bottom table where it says revenue constraint, all right, 10.2 million. This is a very interesting addition to their financials, which we were surprised to learn about. So they have these caveats on that relate to lithium. So you can see this statement here taken from their financial filings. It says, for certain non-cancelable purchase orders, in other words, revenue that's been recorded, the final settlement amount payable to the company is variable. Well, that's interesting, and indexed to the price per ton of lithium carbonate in the first quarter of 2024. So revenues that they're recording in 2023 are variable based on something we're going to learn in the first quarter of 2024. Well, that's not good. And then when you look at the total dollar amount of purchased orders for the indexed contracts, it's approximately $52 million. It says here, the company has recorded the full cost of hardware revenue for these index contracts in the first quarter of 2023. So we can assume that if the total dollar amount of these purchased orders is approximately $50 million, and then the company recorded revenue in the quarter of approximately $42 million, there's a gap there of $10 million, which accounts for what we saw in that previous slide. Now, what this also implies is that the majority of their revenues utilize this pricing structure that we're only seeing this year. And they say here, the difference is a $10 million revenue constraint based on a third-party forecast of lithium's trading value in the first quarter of 2024. Well, if any party out there can forecast the price of an extremely volatile commodity, then they'd probably be making a lot of money off that information. But these are nothing but speculations. And it says here, the company may, pursuant to such purchase orders, ultimately adjust final revenue downwards to $34 million, subject to market conditions upon settlement. So you see this volatility in play here. This isn't a good thing. So sure, they can reflect that new or say updated non-GAAP gross margin, but what it's really brought up here is a concern about the variability of revenues for this firm. And when you look at what they promised in their SPAC deck, it says here, gross margin expands with increasing scale and software growth. Well, we're now in 2023, and you can see that the hardware and software gross margins are nowhere near where they're supposed to be. So that's certainly a problem with the business model. And one might guess that perhaps the lithium hedged or lithium indexed pricing structure that they've developed is a way to remove some of that risk from their clients' table and put it on their own so that they can sell more product. We don't have enough information to make that call, but it's something that's not good for investors because revenues are variable based on something that's being recorded today in COGS, but something that you won't receive revenues for, or you receive a variable amount down the road. Now, on this slide, you can see how they've done some work here on their debt, and they show how they've done some deleveraging there. So they have around $224 million in cash, some short-term investments, so that's about $312 million total. And then net of their long-term debt, that number is lower now as a result of some debt maturity that they've moved from November of 2028 to April of 2030. Now, when we look at their guidance for this year, a couple of things to take away here that are quite interesting. First, they're not just hitting their SPAC deck guidance, they're exceeding it in a big way, and that's impressive. So you don't see a lot of SPACs that do that. The question we'd have is what sort of accommodations are they making in order to hit these numbers, going back to the strange pricing structure they have around their hardware. Now, they've reaffirmed full-year guidance. As you can see, that's above what it says in the SPAC deck there. And note here the breakdown that the percentages of revenue are variable based on the quarter. So, for example, this coming quarter is 15% of total, whilst Q4 of this year will be 3 times that much, or so they say, or 45% of revenues. Now, we look at this company's runway, we can see that they have operating cash flows, negative operating cash flows of about $100 million over the past trailing 12 months. So let's say that gives them about 3 years of runway. Now, just to conclude, we're still avoiding STEM because of those slim gross margins. Their customer concentration risk hasn't improved, or if it has, it's been marginal. And the revenue variability that's now tied to the price of lithium, we don't like at all. And people may look at the depressed share price and think there's value here, but just remember, we invest in companies, not stocks. So we're still actively looking for energy storage exposure. We're holding one stock that gives us some of that, but we're on the hunt for a company like STEM, should they have had the gross margins that they promised. Now, I'm going to put up another video here we did on STEM, which still holds true. Most of the content in there we didn't touch on today. But before you watch that video, please click the Nanalyze logo here on the right. Subscribe to our channel. Thanks for taking the time to watch this today.